U.S. stocks were roughly flat during January as stronger than expected corporate earnings and bullish investor sentiment more than offset rapidly rising geopolitical tensions with Iran and Trump impeachment proceedings early in the month. Later in the month, however, the rapid spread of the novel coronavirus caused the S&P 500 to post its first weekly loss greater than 1% since the Fed started purchasing $60 billion worth of U.S. Treasury bills per month in early October of last year. Foreign stocks posted losses during the month as many economists now believe Chinese economic growth could be 1.5% lower than previously expected due to the negative economic impact of the coronavirus. Lower growth expectations also caused many foreign currencies to weaken relative to the U.S. dollar during the month. Most areas of the bond market posted strong gains during the month as interest rates moved sharply lower. Most notably, the yield on the 10-year Treasury Note fell below the yield on the 3-month Treasury Bill for the first time since last October, a phenomenon known as a yield curve inversion. The yield curve inversion occurred after the Fed's January meeting, in which they left short-term interest rates and the pace of their monthly Treasury bill purchases unchanged, but hinted that any future rate hikes would likely not be appropriate for a very long period of time. The rapid outbreak of the coronavirus and its notable impact on financial markets has unfortunately caused us and many other investors to become amateur epidemiologists. And while it's still far too early to understand the virus, and there are questions around the accurateness of the data coming out of China, early reports suggest the virus is slightly more contagious than the seasonal flu and similarly lethal. To date, there have been roughly 10,000 confirmed cases of coronavirus across 23 countries with 213 confirmed deaths. For comparison purposes, the CDC estimates that the average flu season in the U.S. impacts 29 million Americans and results in 42,000 deaths, with limited to no tangible economic impact. Additionally, we believe if the negative economic impact of the coronavirus becomes too severe, foreign governments and central banks will likely look to stimulate economic growth through monetary and fiscal stimulus measures. As a result, we view any additional significant negative market impact from the coronavirus as an opportunity to trim our high-quality bond positions and add to positions in value, high-quality, dividend-paying equities in line with our overall defensive posture and investment outlook.